The Bitcoin Liquidity Trap, May 2026 update. Bitcoin has matured. Wall Street is fully on board. Spot ETFs are swallowing billions, and sovereign nations are treating it as a legitimate reserve asset. By all traditional metrics, Bitcoin won. But behind the massive price tags and institutional validation, a quiet crisis is brewing, one that the average retail investor completely misses. It's called the Bitcoin Liquidity Trap. And right now, in May 2026, the jaws of this trap are shutting closer than ever before. If you think a lack of buyers is what crashes a market, you're looking at the wrong map. Today, we're breaking down why Bitcoin's greatest strength, its absolute scarcity, is turning into its most dangerous systemic risk. To understand the trap, we have to look at where the coins are actually going. Over the last 2 years, institutional accumulation has hit overdrive. Corporate treasuries, massive pension funds, and spot ETFs have been vacuuming up every coin they can find. But these institutions aren't day trading. They are hodling on an industrial scale. According to recent on-chain data, over 75% of Bitcoin's circulating supply is now classified as illiquid.
It hasn't moved in months, sometimes years.
Bitcoin is being pulled off the open market and locked into a digital black hole. On paper, this sounds amazing for bulls. Less supply plus steady demand equals higher prices, right? Well, only until the wind changes direction. In traditional economics, a liquidity trap happens when cash sits idle because people expect a crisis. In crypto, the trap is structural. Because the pool of actively traded Bitcoin is shrinking so fast, the market's order books are becoming dangerously thin. Think of liquidity like water in a lake. When the lake is deep, a giant battleship can cruise through without causing a disruptive wave. But when the water drains, even a small speedboat will scrape the bottom and cause massive ripples. In May 2026, the Bitcoin market is shallower than it looks. Because active liquidity is trapped in cold storage and institutional vaults, it takes drastically less trading volume to move the price by thousands of dollars in either direction. This brings us to the danger zone. The forced liquidation cascades. Because the spot market is so thin, derivatives and leverage trading have taken over the steering wheel. If a major macroeconomic shock occurs, say, an unexpected interest rate shift or a geopolitical event, and a few large entities are forced to sell, there won't be enough day-to-day liquidity on exchanges to absorb the impact. The price slips. That slip triggers automated stop losses. Those stop losses trigger leveraged liquidations. And because there aren't enough active limit orders sitting on the books to catch the falling knife, the price doesn't just dip, it teleports downward in a flash crash. We saw hints of this in past market cycles, but in 2026, with institutional algorithms managing the exits, the cascade can happen in milliseconds. So, how do you survive a market built on a liquidity tightrope? First, stop tracking just the price. Start watching the exchange reserve metrics and order book depth. If you see liquidity on exchanges hitting all-time lows, expect extreme volatility. Second, respect the leverage. In a thin liquidity environment, using high leverage is financial suicide. The market will hunt liquidations to create its own liquidity. Third, keep a long-term horizon. If you're here for the fundamental thesis of Bitcoin as digital gold, these liquidity-driven flash crashes are structural anomalies, not failures of the network itself. Scarcity made Bitcoin a trillion-dollar asset, but illiquidity is what makes it a wild ride. The trap is set, and the market is more sensitive than ever. What's your game plan if we see a massive liquidity squeeze this quarter?
Let me know in the comments below.
Don't forget to smash the like button, subscribe for more macro updates, and I'll see you in the next video.